Hello. Always dangerous in Italian with the microphone. I start crooning. Welcome everyone to to our annual lecture in memory of our colleague Aaron Graham. It's a pleasure to welcome his family and to welcome our speaker of this evening, Professor Pat Hudson. From many places, Cardiff is the last one. My name is Antonio Sennis, and it's a delight for me to be able to welcome you on behalf of the History Department. Sorry. This is a very important event from us. Last year we had the first of these lectures that now we've been able to make into an annual event. And we've been able to do so also because of the help in sort of funding, organizing, and promoting this lecture that has come from the Economic History Society. And Patrick Wallis, its president, is here this evening to actually chair the lecture, and he was happy for this invitation, which came so late in the day that he was kind of happy, but sort of say, okay, I could have woken up a little bit earlier to have this idea. But anyway, Patrick, thank you so much for accepting the invitation. I also would like to thank my friend and colleague Josh Kuntuncher, who is a professor of economic history in my department. He is the driving force behind these lectures. So, Patrick, over to you. And after the lecture, we will all be upstairs at the sixth floor of this wonderful building for refreshment and an informal chat.
Thank you very much, Antonio. He's just told you we're going for drinks afterwards, right? So this is a bad moment to start speaking. But it's a real pleasure to be here at the second of what is now the annual Aaron Graham Memorial Lecture. I know that I speak for all of the Economic History Society in saying how pleased we are that we've been able to take something which was a celebration of an individual's contribution and turn it into something more durable, to stand as a kind of permanent marker of his work, and also a moment to celebrate the future of the field. So we have this lovely combination of a chance to hear some of the work that's very much at the frontier of economic history, and also to remember someone who helped shape that frontier in their career. I think Aaron would be really proud of what we've done here, and particularly of what Josh Kuhn and the department have done to make this possible. So my job is to introduce Professor Pat Hudson, to give her the full title, who is speaking today and giving today's lecture. Pat, as Antonio said, is an emeritus professor at the University of Cardiff. She is undoubtedly one of the most distinguished economic historians practicing in the UK today. She's a fellow of the British Academy. She's a fellow of the Academy of Social Sciences. I'm trying to make you blush. She's also a former president of the Economic History Society, so she's done this job as well as that job, among many other honours. Pat's body of published work spans now a full half-century. I'm sure you're pleased with me saying that. And she began with what is the defining book on the role of capital and finance in the wool and textiles of the West Riding of Yorkshire. And then she built on that, and every step seemed to get bigger, taking on the British Industrial Revolution, taking on global economic history. And when I last counted, I think she was up to 13 books. That was a couple of years ago. I think there may be more, which I found slightly daunting, frankly. Most recently, she's been writing about the relationship between slavery and British economic growth, which is both an enormously important economic history question, also a really important political question and cultural question and social question for Britain today, as well as Britain historically. She published a lovely book on this with Maxine Berg, who's also here today, called Slavery, Capitalism and the Industrial Revolution, just a couple of years ago. My understanding is that what we're going to hear today builds upon this. It's not in the book, it's new. But it reflects that twist and turn of interest towards these questions about how we connect the institutions of slavery, the Caribbean, and what happened next, so to speak. So Pat is exactly the kind of academic that I think Erin would have wished to hear from.
Hope so.
She's willing to ask the big questions, but her answers are rooted in real history. So Pat, let me invite you to speak on Caribbean investment and the financialisation of the British economy in the 18th century.
Thank you, Patrick. Thank you very much, Patrick. It's a great honour to be invited to give the second Aaron Graham Memorial Lecture. British imperial history and the history of British colonialism has lost a first-rate key historian. And Aaron was very generous too with his knowledge. I benefited a great deal along with countless others. And this lecture is a beneficiary too of his ideas. I start with two propositions. First, that trade and financial services began to drive the British economy of the 18th century, presaging its later nature in the 19th century in particular. The tertiary sector exceeded the industrial share of GDP even as the Industrial Revolution took off, and this excludes almost all financial transactions because they are outside the scope of GDP calculations. They don't figure because they don't represent income from current production. The financial interrelations ratio gives an idea of what's missing from GDP in terms of asset creation through finance. It tracks financial assets as a proportion of tangible assets. And although Goldsmith's figures are conjectures, I think they are suggestive. My second proposition is that trade wars, the slave trade, Atlantic markets and plantation commodity trading were major forces radically transforming the financial sector in the 18th century, creating an early form of financialized economy. So how did the transatlantic trading system influence the financialization of the British economy? A full answer would have to involve all of the following and more. And in practice, of course, although they're separated here for simplicity, public and private finance were inextricably interrelated. Protected colonial trade increased the state's fiscal capacity and facilitated the conversion of government debts into tradable assets. International trade, shipping high-value cargoes, and handling highly flammable raw materials, sugar and cotton in particular, brought Britain's insurance sector to prominence. Heavy investment necessary for plantation development changed capital markets and asset trading, already pioneered by government stock and Royal Chartered Company shares. Multilateral payments, especially those developed for Atlantic trading, expanded the use of paper credits and increased the money supply. This encouraged speculation and volatility, which increasingly prompted intervention by the government and the Bank of England to avert crises. Now, the focus of my lecture tonight is just one part of this financialization, the mobilization of land, the greatest store of private wealth in pre-industrial society, as collateral for debt. It's important because the more that loans are used for commercial and industrial expansion, the more these cease to be constrained by the savings or ploughback of merchant or industrialists. Adam Smith first highlighted, and research in recent decades has confirmed, that the slave plantation trade nexus rested on unprecedented extension of metropolitan credit and capital. Contemporary estimates put the private debt owed by colonial planters to metropolitan financiers at between 20 and 30 million pounds by the 1770s. In 1789, Richard Pennant, Jamaican plantation owner and founder of the slate quarrying industry of North Wales, suggested that the value of Caribbean mortgages alone was as high as 70 million, which would equate to over $1 trillion today. And by 1813, William Young, then governor of Tobago, believed that 3/4 of the estates of the Windward Islands were burdened with mortgage debts secured by land and enslaved workers. Precise figures are unknowable, but raising money on the security of plantation assets was ubiquitous and growing, especially after the 1760s. The Atlantic was much more important than the East Indies in the 18th century in its use of the institutions of investment and capital markets in Britain. Only in the early 19th century did the East Indies investment start to engage with British financial markets in the same way that the Caribbean had throughout the 18th century. This came only with the rise of agency houses in India and with new territories such as Sri Lanka and Mauritius being developed for tea and sugar plantations. So this is the outline of what I intend to cover this evening. Extensive mortgaging of colonised land started in Ireland in the 1660s. 64,000 acres of Catholic estates were awarded to investors and military men who had enabled Cromwell's reconquest. The land was nearly all quickly resold and mortgaged on a scale that London's financial markets had not experienced before, and they had to quickly respond. Leading figures from London's mercantile and financial circles benefited from the Irish bounty. It's no accident that a third of the Royal Africa Company's 198 original subscribers, that's the chartered company who had the monopoly for slave trading, in 1671, a third of the subscribers had received 50% of the sequestered Irish land. In this way, as David Brown has argued, the Great Gage, or the Great Mortgage of Ireland, helped to finance later colonial expansion. It also established a practice of surveying, mortgaging and remortgaging colonised land that followed metropolitan financiers and merchants from Ireland to the Atlantic. Mortgages were used as a tool for the dispossession of North American First Nation peoples whose culture had no notion that land could and would be forfeited for unpaid trade debts. And Atlantic colonial legislatures were from the outset focused on expanding collateral because credit and loans underpinned the whole slave plantation system. New owners bought land in installments and through mortgage borrowing, raised money for clearing and expansion, and bought enslaved workers on credit, relying on periodic sales, sometimes only merchants and investors. The wealth that sugar in particular could generate attracted lenders and created interdependent bonds of credit and debt between planters, merchants, and metropolitan bankers. Early colonial legal frameworks for debt, inherited from English common law, were moulded to suit different colonies and their agrarian regimes. But unlike in Britain, most colonies necessarily, from the outset, accepted that land should be treated like any other financial asset. Enslaved people were also favoured as collateral because they could easily be seized to satisfy a debt judgment and auctioned off to release money. Finally, all Atlantic colonies early developed title and mortgage registries to provide potential lenders with information about estates and existing mortgages at low cost. Such registers existed well over a century before their equivalent in Britain. After lobbying by British creditors, the law regarding debt was standardised across all British Atlantic colonies by the Colonial Debts Act of 1732. All land, houses, plantation premises, and enslaved workers were declared assets available to satisfy creditors' claims, including unsecured creditors. The Act also allowed British merchants to obtain easier judgments in disputes about debt in courts in Britain, in England, in London. Land law and practice now differed markedly between the colonies and Britain. Parliament was only willing to give unsecured creditors a claim on the British estates of debtors 150 years later in the Conveyancing and Settled Land Acts of 1881-2. But in the colonies, from 1732, creditors' claims trumped the interests of landowners and their heirs. William Knox, Secretary of State for the Colonies in the 1770s, famously called the Act the palladium of colonial credit and the English merchant's grand security. Colonial land became more liquid and more readily available as a source of investment capital, along with enslaved workers. The Act did much to further the dynamic of debt-based colonial exploitation and facilitated the growth of the slave trade, which outstripped the French by 1740. But it also encouraged speculation and infused the British Atlantic economy with high levels of risk and volatility. The mortgage market in the Caribbean expanded after 1732, as you might expect it would, and especially after 1763, when the ceded islands became a new magnet for investors and speculators. Acts in the 1770s gave increased security to non-British mortgagees and regularised interest rates on mortgages at 6% in the Caribbean and in Ireland. Mortgages increased after the American Revolution, after the San Domingue Rebellion in 1791, in the decades of mixed fortune just before and just after the ending of the slave trade, and after the 1815 acquisition of the fertile Dutch colonies that became British Guiana. Foreclosures and remortgaging occurred after each wave of expansion, and many merchants became plantation owners by default. Defaults on long-term debts, in addition to land sales, inheritance, and remortgages, created hefty commissions for financiers, intermediaries, and lawyers, enriching the institutions of financialisation. In Richard Sheridan's words, the whole value of the West Indian colonies was paid for over and over again, and the proceeds quietly deposited in Britain. Apart from the favour given to creditors in the 1732 Act, interest rates were higher in the colonies by between 3 and 4 percentage points in peacetime, and sugar estates held as collateral were rapidly appreciating in value. Caribbean mortgages were underpinned by the potential fortunes to be made in sugar sold in the rapidly expanding and protected home market, and by mid-century decades favourable terms of trade for colonial produce. Finally, for commission merchants as mortgagees, such as the Lascelles and the Pinneys, loans were routinely made on condition of handling the sugar trade of the plantation in question. So granting a mortgage or lending on the security of a plantation could also bring with it, on condition, a large amount of the sugar trade. To take an example, Nathaniel Phillips was the illegitimate son of a London trader in the West Indies. He sailed for Jamaica in 1759, returning 30 years later a wealthy man. In 1789, he bought the Slebeck estate in Pembrokeshire, which is quite near where I live, and partly why I've chosen this case study, because the local history society in my village is doing a project on local slave owners. He bought the Slebeck estate in Pembrokeshire, establishing a patrimony is still in the Phillips family today. Phillips had little capital at the outset, but good connections, including with the Hibberts, planters and sugar importers. This gave him access to loans and to mortgage-based borrowing. Over time, he bought 3 sugar estates and a livestock farm, stocking them with hundreds of enslaved workers and the industrial equipment necessary for sugar and rum production and processing. His plantations were leveraged as collateral as soon as they were acquired. The fact that they were rapidly appreciating in value made them an attractive asset for creditors. By his death in 1813, the net worth of his Jamaican estates was at least 130,000, excluding the value of his enslaved workforce. And that would be equivalent to over 10 million today. Debt charges on his plantations were so important that more than 2 decades after his death, at the time of abolition in the 1830s, compensation for the remaining 258 enslaved workers on his plantations was still being contested. And eventually it was awarded not to his heirs, but to his creditors, George Hibbert and Roger Harris. The legal and other foundations for an active mortgage market had been laid in Britain from the mid-17th century. Entails were weakened in the 15th and 16th centuries, and the 1660 Statute of Tenures ended the Crown's right to create feudal obligations on land grants in favour of free and common sosage, essentially freehold rights. The door to expanded use of land as security for credit and loans was thus opened before the Glorious Revolution. But the practice of strict settlement developed during the mid-17th century to satisfy the dynastic ambitions of landowners and to ensure the durability of their assets. This effectively removed around 50% of the land of England and Wales from the open land and mortgage markets by the 1760s, rising to around 90% by 1850. Now, as many of you will know, strict settlement was a complicated business, but it was an early form of prenuptial agreement and limited liability rolled into one. Based on primogeniture, it provided newly married wives' jointures and portions for younger legatees, whilst also protecting familial descent of landed estates. Typical was that of Charles Goring, portrayed on the title slide this evening. In 1779, it provided for Sarah Beard, his first wife, an annuity of £400 a year if he predeceased her, and entailed his estate for 100 years to his heirs. Strict settlement, as most obfuscations of property and wealth ownership, even today, worked through the creation of a trust similar to a shell company, which took legal control of the estate. The current owner became the tenant for life. The trustee held the formal title, but neither could sell or mortgage the land. The need for strict settlement to be periodically renewed made it more flexible than the Scottish entail or tailsy that was common both before and after the Union and endorsed in the Entail Improvement Act of 1770. Entails in Scotland covered around 20% of Scottish land in 1770, but they did increase in popularity markedly after the Act. Strict settlements and entails were relatively rare in the colonies, so law and practice regarding the land market in Britain were much more restrictive both before and especially after 1732. Peripheral parts of large estates in England and Wales were sometimes excluded from strict settlement, and strict settlement was rare amongst the lower gentry and smallholders. So it is the case that a significant amount of land in Britain remained available to be pledged against debts during the 18th century, even though a lot of it was tied up by these settlement arrangements. Under strict settlement, wives' jointures and portions for the contingent remainders, the younger legatees, or the junior legatees, were generally paid in cash and not in land. And these cash portions became a charge on the estate. This not only freed younger siblings for commercial and imperial careers, but it also made strict settlement itself an engine of debt and of mortgage development. Inheritance charges on estates added around 5% to their encumbrances in each generation, according to the key historian of this topic, Hrothgar Habakkuk. They could not have operated, however, without mortgages. The London Scriveners' Bank of Clayton and Morris was instrumental in pioneering the long-term land mortgage in the third quarter of the 17th century. And for 40 years, they were the largest brokers and lenders to landowners in the Midlands and the southeast of England. They arranged the marriage settlements and family affairs of their clients. They weren't just bankers, they were lawyers and scribes and land surveyors. They surveyed the land, they managed foreclosed estates, and they brokered loans. They had 1,000 and more employees in the provinces as well as in London, if you count them all. The time between clients' deposits reaching the bank and when those deposits were loaned out allowed Clayton and Morris to lend the money for their own gain. And they avoided the restrictions of the usury laws by charging fees for all services associated with the loans. And as you can imagine, it was hard to prove where fees ended and interest on the use of money began. In 1672, one Thomas Dolman accused Clayton of taking the equivalent of over 16% interest on what was a relatively small loan of $2,500. It was a good time, in other words, to be a mortgage broker if you married it with being a family lawyer, a scribe, a land surveyor, etc. And in language that might not be out of place describing the CEOs of water companies today, Daniel Defoe, amongst others, saw Robert Clayton's activities as morally reprehensible. It's a bit tangential to my topic tonight, but I had to include that quote once I'd found it. Landowner debt increased over the 18th century. By the 1820s, land in England and Wales was encumbered by debt to around 50% of its value. This had risen from under 10% in the late 17th century. These are again figures from Habakkuk. A relaxed attitude to debt accumulation amongst landowners was encouraged above all by the equity of redemption, which has all sorts of religious and moral connotations just in its name. This was a thing worked out in the Court of Chancery from the mid-17th century. By this, the mortgager gained a continuing right to redeem his land despite payment arrears, which could sometimes run into months and years before the Chancery Court would sustain a foreclosure or even the thought of one. The right of the mortgagee eventually, thus, became limited to a claim for money rather than the mortgaged land. It was applied in disputes irrespective of the terms of the original agreement, eventually, as you get into the 18th century, safeguarding the estates even further of landed families without discouraging lenders whose right to monetary income from the loan was upheld. Mortgages were increasingly treated as a safe and popular form of investment in Britain, yielding higher than land or government stock. Foreclosure was complicated and expensive, but mortgages were now more easily securitized, an important step. In other words, they could be sold or reassigned on secondary markets. Mortgages on Caribbean estates, by contrast, could yield higher profits and were much easier to foreclose, but other risks were higher than for British investments. The Barbados plantation owner, customs collector, and sugar merchant Henry Lascelles of the wider Lascelles merchanting family made loans on mortgages in both Britain and the West Indies in the mid-18th century. Mortgages dominated his West India loans as early as the 1740s, which does reflect what I've been saying about the growing importance of insisting on collateral and easy collateral. And yields were markedly higher for those investments than for other areas of investment. The only one that comes near it is his East India stock. But as he was a director of the East India Company and was accused of insider trading at one point, or the equivalent of, I think we know why that particular percentage is quite high. So to summarise at this point, with the development of trusts and the new sophisticated conception of mortgages, a balance in Britain was struck back by law between alienability and the need to preserve intergenerational integrity of large estates. The latter was a luxury generally not afforded in the colonies, where creditors needed to be prioritised to keep the system of indebtedness trading afloat. Crises in the late century exposed how dependent the system had become on relatively illiquid and often by then overvalued plantation mortgages. This begs a question to be explored elsewhere of whether a different balance between debt and equity capital in colonial enterprise would have created a more stable system. But of course, after the Bubble Act, this wasn't so easily accomplished. I seem to have got through this lecture rather quickly because I'm now at the point, so maybe we'll take questions, in saying what can we conclude about the role of colonial reality-secured debt in the financialisation of the British economy. And the devices and practices of land law, inheritance and the use of land as collateral for debt that emerged in Britain from the mid-17th century were not simply transposed to the colonies. Neither was the law imposed in the colonies to secure essential trade, credit and capital transplanted back to industrialising Britain. But the popularity and sophistication of mortgages in Britain aided the acceptance and encouraged the ubiquity of securitized mortgages for business purposes in the Atlantic colonies. And colonial practice and experience influenced the financialisation in Britain. In the Caribbean, mortgage debt underpinning agribusiness became the norm. Improving owners and merchants in Britain had access to some of the same London brokers, bankers and investors, like the Lassalles, who supported West Indian planters as mortgagees. Much more importantly, they had access to the accumulated wealth of London's financial markets that had been partly secured by the sugar trade and by profits from colonial mortgages and financial services. Finally, strict settlement and entail in Britain secured the durability of Caribbean fortunes like that of Phillips, and much more ostentatiously that of the Lassalles, the Beckfords, and countless other plantation families, by enabling absentee and returnee planters to lock their gains into landed estates in Britain. Back home, they could secure a patrimony far more easily than under colonial law and conditions, especially after 1732. A landed estate in Britain could be protected by taleses in Scotland or by strict settlement in England and Wales right through to the Settled Land Acts of the 1880s. This ensured that the direct financial gains from colonialism were largely repatriated, and it helps to explain the high absenteeism rates of planters, as high as 50% in Jamaica by 1800, but very common throughout the Caribbean. In July 1788, Nathaniel Phillips, our friend from Slebeck, wrote to his creditor, George Hibbert, that he would soon have the capacity to produce 600 hogsheads, around 500 tons of sugar annually on his 3 estates. I would hope with it that I shall find some property in England, the best cure for my Swiss malady, he wrote. This had indeed been the purpose of his 3 decades in Jamaica, and he returned and bought Slebeck Hall the following year. Thank you very much. I'm afraid I've erred on the side of much speed, so as not to make it drag on too long. But I'm in your hands, Patrick.
Well, I think we have some time for questions, and brevity is always welcome, particularly in the evening. So,
well, it's great to have time for questions.
I'm going to open the floor. I think, Antonio, I'm going to trust that you'll wave to me when we have time to, start. Yes. Yes, of course. That would make sense, I think, to do that after a few questions, wouldn't it, Robert? Yeah.
That's fine.
Brilliant. So let me look around. Let's start there, and then we'll go to the back afterwards. Let me bring you the microphone.
Could I ask you to speak up, because I haven't got my hearing aids in.
Can you hear me? Brilliant. At the end, you mentioned the Swiss disease. Is that because the Swiss at the time were also known as bankers, and that's a nickname for some complex financial malady?
That would be a nice idea, a nice suggestion. But Swiss malady was a common phrase used for melancholy, melancholia, from being in the colonies too long and wanting to be back home. It seems to have been a term synonymous with melancholy.
Thank you.
Thank you. I wanted to ask whether you have come across any instances of people living in the Caribbean feeling frustrated at the differing system in the Caribbean versus in Britain. Obviously, frequently a fount of tension between the people living in the colonies and those in the metropole, that their systems are unequal. And I think easy to imagine that a system in which property is more easily foreclosed and burdened by higher levels of debt would create that level of frustration.
Well, that's a very good question, but there was very little opposition, even in the colonies, to the Colonial Debts Act in 1732. And it was brought about by the lobbying of London slave traders, who were big creditors, as a result of the slave trade and selling slaves on credit, enslaved people on credit. But there was very little opposition in the colonies to the Act, and most historians I've consulted, suggest that this is because it was recognised just how important loans and credit were to the whole system, and that the price to be paid had to be this great insecurity of ownership of estates.
Thank you very much.
And an easy mortgage market, and easy foreclosure.
Thank you. I've got 2 more. I'm just going to deliver. I think you were first. Brilliant. Yeah, sorry.
I'm part of the way through reading, rereading rather, the Black Jacobins.
Could you speak up,
yes,
please? Sorry.
Sorry, so part of the way through rereading the Black Jacobins, and a big feature of that is the kind of interplay and tension between the metropole and, in this instance, Haiti, or the landers in Haiti. I was wondering whether there was a similar tension at all in Britain between the planters on the one hand and the metropole.
Between what was that last?
Oh, sorry, between the planters and the metropole.
I'm no expert. Probably other people in the room would be able to answer that question better than me. But as I said in answer to the last question, I think there was the common recognition that collateral had to be treated differently in the colonies because of the extent of dependence upon debt. So it's almost the same answer I've just given, I'm afraid. But maybe someone else in the room would know more about planter frustrations.
That's a very democratic answer. We can invite people to raise their hands. But one more question, I think, and I'll check in with Antonia well. Just go to the middle there.
Hi, thanks for the lecture. I was just wondering how you go about, or how you go about finding out how much land of the estates held under strict settlement in England is kind of available for mortgaging, because we've got these big estimates that Habakkuk uses, 90% in the 1850s, but these are contemporary estimates. And it seems very difficult to find out exactly, how much land is being used.
I'm no expert again. I imagine it is impossible to find out. And you see, I started my career, as Patrick said, by doing my PhD on the West Yorkshire woolen industry and how the early generations of those manufacturers who transitioned from putting out systems to the factory, how they got their capital. And one part of that study did look at the mortgaging of land. Now, I haven't included any of that. I originally thought I might, in the research for this lecture, try and bring it round to industrial investment in Britain and maybe slant the lecture differently, not so much about financialisation, but about whether the development in mortgage law and practice in the colonies reflected back at all on the availability of land for industrial expansion in Britain. But if I was asked about that now, and partly why I left it out, is it's a whole different kettle of fish, because it seems to me that there's a completely segmented mortgage market. And at the lower level, you've got all the small holders from minor gentry downwards who haven't got involved in strict settlement, who even don't involve in primogeniture. They have a more egalitarian system of inheritance. And so they haven't got the equity of redemption would be too expensive to follow, and they haven't got these rigidities. And there is a very expanding use of small mortgages on relatively small areas of land, 10, 12 acres, sometimes less, amongst small manufacturers. They're in debt to the hilt to try and expand their businesses at a time when it's not so much the costs of the transition to the factory, but the costs of credit extension for buying raw materials and selling finished products. So, although I couldn't possibly hazard a guess, even though Habakkuk says, it's down to 10% of the land is remaining. But there's also, you see, areas of states that don't get involved in the strict settlement agreements, which are there for the mortgaging and the raising of money for portions for younger legatees, as I tried to explain. But just to go back to this segmented idea of the segmented mortgage market, small manufacturers are borrowing. They can access pockets of provincial wealth, not via London and not via the mortgage markets in the capital that I've really concentrated on in the talk, but via the activities of local attorneys, putting lenders in touch with borrowers. There's much less securitisation, there's much less onward selling of these mortgages. They tend to be arrangements between lender and borrower that remain in place until the debt is settled. And this is a very different sort of mortgage market at the lower level, but very active, particularly in the industrialising provinces. And, it could be the topic of a wholly different paper, actually. I hope that's answered your question.
Brilliant. And now one last question before we close.
Thank you. I was just wondering if you could comment on, can you hear me? Can you hear me?
Just about.
Okay, I was wondering if you could comment on the role of the Bank of England in participating in the development of the mortgage-based borrowing and the market, whether it participated or had any role whatsoever.
The role of the Bank of England in interest rate
No,
determination?
in the mortgage-based borrowing.
I could probably only contribute a little on that, very little on that. I did intend to do some more research on the Bank of England for this paper, which I didn't get round to doing, so I'll hands up to that. Obviously, the Bank of England is a major engine of the creation and solution of government debt, the solution to the problem of rising government debt. And that's its main function in the early part of the 18th century. I don't have any information about direct involvement of bank capital, Bank of England capital in the mortgage market, but I might be completely mistaken about that. And if I am, it's mea culpa in terms of insufficient research. But thank you for the question, and let me know afterwards if you know much more than I do about this. I suspect you might.
Thank you, Pat.
Thank you. Can everybody hear me? Yes, at the back? Good. I don't have a huge amount of experience of talking to an academic audience, but I've got a lot of experience talking to lawyers, and I know the worst slot to have is the one between the lecture or the talk and the drinks and the reception. So I'll try and be very brief. I'm speaking today on behalf of myself. I'm Erin's father and my wife Sharon, Erin's brother Josh and his wife Emma. But I believe I'm also speaking on behalf of everyone in the room when I thank Professor Hudson, Pat, if I may,
My pleasure.
For her thought-provoking lecture. There were many echoes as I listened to issues that we talked about with Erin and also issues that we're dealing with today, which is often the case, transference of estates and so on, live issues today. And it was extremely interesting and thought-provoking. I'm sure the discussions will continue over drinks later on. I'm also very grateful to you, Pat, for your kind words about Erin's work and his contribution. Erin always greatly valued the opinions of his fellow academics, and knowing how well he was and is regarded by his colleagues and peers is a great source of comfort for us all. I'd like to thank Antonio and all his colleagues at UCL, the Economic History Society, for arranging this lecture. We recognise the honour this is for Erin as an academic, and we're particularly grateful to all of you in the room for coming along and supporting this series of lectures. And we're extremely grateful that this is becoming an annual event. For all of us, it's a key part of preserving Erin's legacy, and we continue to take pride in his continuing achievements. Earlier this year, Tropical Leviathan was published. Erin finished the manuscript just before he went into hospital. And we're hugely grateful to Trevor Bernard, who completed the work, and Professor Peter Wilson from Oxford University, who managed the process through to final publication. Very sadly, Trevor passed away soon after his work was completed, and he did not live to see the book in print. But we remain forever in his debt. Separately, Peter Wilson has been working on the finalisation of Erin's article on the British fiscal military state, to give it its title, which is for publication by the OUP in the English Historical Review, hopefully later this year. The article sets out Erin's hypothesis arising from his involvement in, and to give it its full name, the European Fiscal Military System 1530 to 1870 project. Not surprisingly, he used to use a shorthand, which was infinite money. As an accountant, that was a concept that always intrigued me. And finally, on a different track entirely, we're hoping to work with Antonio and his colleagues at UCL to fulfill Erin's commission to write a new introduction to the general history of the pirates, originally written by Captain Charles Johnson in 1724. If nothing else, these projects highlight, I should say, the varied and eclectic mix of Erin's interests. Separately, but also on the subject of achievements, I should mention the refurbishment of the family rooms in the critical care unit at UCH, just around the corner. That refurbishment has finally been completed, and the rooms will be officially dedicated in Erin's memory next month. This fundraising initiative was launched shortly after Erin's passing. It's been generously supported by our many friends, family and colleagues, and I'd like to take the opportunity to thank them publicly. We are delighted that something so positive has come out from this tragedy. It's now over 2 years since we lost Erin, and we still find it hard to believe that he's no longer with us. The last year has been difficult, and every day is a challenge, but we get through it by continuing to focus on all that Erin achieved and by talking about him all the time. What would Erin have thought is a very common part of all our conversations. We miss him, and we always will. And so, in conclusion, I said I'd be brief. I'd like to thank you, Pat, again, on behalf of Sharon and myself, Emma and Josh, and thank everybody involved in organising this lecture. I know a lot of work goes into making these events happen, and we're very grateful. It helps to keep Erin's work alive and relevant, and it's most definitely what he would have wanted. Thank you very much.